If my sales are up, why don't I have any cash? I've sat in several meetings recently with business owners that are all asking the same questions, just using different words. My sales are up, but my bank account is low. What's the deal? My profit and loss says my net is real high, but I still have to take out loans to make payroll or purchase inventory. My tax return shows that my net is high, but I don't have the cash to make the tax payment. Today, I'm going to explain why profit and cash are two different things and the three main reasons that businesses run out of cash. How are profit and cash different? Profit is an accounting concept. Cash is reality. Today, we're going to reference several different reports, but we're going to go in depth with two of them. In our examples, we're going to show why only using one report muddies the waters for good decision makers. One of those reports is the profit and loss. The profit and loss report is a report that shows a period of activity. The activity consists of sales, cost of goods sold, and other overhead expenses calculated to determine net income. We're also going to talk about cash flow reports. Cash flow reports consist of all bank accounts, safes, cash tills, registers, things of that nature, all cash combined, and the incoming and outgoing amounts that affect those accounts. They sound the same, but they're not. And here's a prime example of why they're different. If I invoice a customer today for a sale for $10,000, the profit and loss would show an increase in $10,000 sale. But if that customer doesn't pay me right away, maybe he pays me in 3 or 4 weeks or 2 months, who knows? If that customer doesn't pay me today, my cash doesn't change, but my sales go up. So the profit and loss looks better, but my cash flow has no change. 3 biggest reasons why businesses run out of cash. Reason number 1, customers haven't paid. So you've made the sale, you've earned the revenue, so your profit and loss is showing an increase of sales, but the customer hasn't paid yet. The other side of this is you've already incurred the expense that goes into making, producing, or providing a service to that customer. So you purchase the raw materials or you purchase the products that go into the service that your company provides. You've even made payroll to your employees that provide those services. Either they sold the product, they distributed the product, whatever the case may be. You've also incurred those expenses and any additional overhead expenses that go into that. Keeping the lights on in your factory or putting fuel in your work vehicles. You've incurred the expenses to provide your product or service. You've sold that product or service, but yet your customer hasn't paid yet. This is obviously a problem, but when it comes to scaling and growing your business, that ratio, that proportion gets even bigger. So as you increase in sales and you increase those expenses, the divide between your cash flow gap grows because your expenses increase, but your cash flow incoming is not growing with it. Reason number 2, purchasing inventory. So we have to purchase inventory, not making the claim that you shouldn't, but we should use a magnifying glass when it comes to how we purchase this inventory. Timing is important. The amount is important. Our sales projections are important. All 3 of these things should be considered when purchasing inventory. Because when we purchase inventory, it does not show up on the profit and loss right away. Purchasing inventory shows up on a different report called the balance sheet. So when we're looking at our profit and loss statement and we purchased inventory, it's not going to show up there. But when we purchase inventory, it does show up on our cash flow statement because we took actual cash and made a purchase, decreasing our cash flow, but no effect on our net income. The next piece of that is unsold inventory is just unused cash. Inventory should be understood that it is not cash. It is cash sitting on a shelf. So while it negatively impacts your cash flow statement until it is sold. Reason number 3, debt payments do not show up on a P&L. Hey, this can be a big shocker to business owners. If you have a loan or additional financing, credit card payments, whatever the case may be, making those payments do not show up necessarily on your profit and loss. The only thing that does show up is the interest that's paid on those statements. So you make a loan payment and say 3% of that or whatever is interest. The 3% does flow to your profit and loss, but the portion of that payment that goes to the principal goes to the balance sheet. So again, you have this amount that comes out of your bank account, therefore reducing your cash flow, but it does not show up on your profit and loss, except for a small portion for interest. So this is another instance in where measuring your profit and loss to determine cash flow is not effective. Here are a few other items that drain cash flow but have no bearing on the profit and loss. Owner distributions. Owner takes the distribution, reduces cash flow, no impact on the profit and loss. CapEx, capital expenditures. So if you buy a new machine, a new vehicle, something that shows up as an asset does not show up on the profit and loss. Tax payments. You make a payment to the IRS or some other state agency, local municipality, those payments also do not show up on the profit and loss. So here's from your CFO perspective. Okay, if you're only reviewing the P&L, you're missing out on some key pieces. We mentioned how purchasing inventory doesn't show up on the profit and loss. Therefore, the profit and loss is not a good measuring tool to determine cash flow and how it affects inventory. And that's a lot. But the point is, using just one report is not an effective measure of strategy. You need to use multiple, if not all, other reports available to us. Cash problems do not usually happen overnight. They usually show up weeks, even months in advance. So it's important to create this cash flow report based on several factors and have kind of a rolling 13, even 26-week count. We want to be looking and projecting ahead. It's time to get proactive instead of reactive. So if you've ever asked yourself something like, hey, my business is profitable, but I still don't have any cash. What's the deal? The answer is usually customers haven't paid, inventory is consuming your cash, debt's constricting your cash flow. Hey, go check out our website. We might have some more details that are specific to your industry. And if you have any questions, feel free to reach out. We'd love to help. Thanks.